The world is in economic turbulence. In light trading, stock markets edged higher, European bond yields fell, and the dollar held steady as markets began for the new year, despite warnings from the IMF's managing director that a third of the world will enter recession in 2023. This week brings employment data and minutes from the most recent Federal Reserve meeting, as 2023 begins with continued uncertainty over the Ukraine war and the fear that interest rate hikes intended to moderate inflation would lead to a recession. The DAX in Germany rose 0.5% in early trading to 13,996.02, while the CAC 40 in Paris rose 0.7% to 6520.71. Markets in the United Kingdom and the United States are closed on Monday in observance of the New Year's Day holiday. In Asia, the Kospi in South Korea declined 0.5% to 2225.67, while the Sensex in Mumbai rose 0.4% to 61,109.23. Jakarta's benchmark was unchanged. A report released over the weekend revealed that Chinese manufacturing declined for the third consecutive month in December, the worst decrease since February 2020, as the government grapples with a nationwide COVID-19 rise after abruptly relaxing anti-epidemic policies. According to the National Bureau of Statistics, issued on Saturday, the monthly Purchasing Managers Index fell to 47.0 from 48.0 in November. Numbers less than 50 suggest a decrease in activity. It is unclear what effect the removal of rigorous COVID-19 restrictions in China that hampered raw material and commodities manufacturing and discouraged mobility will have on the global economy. The threat of a recession in the United States and other major economies and a prolonged decline in China are all factors weighing on markets. We expect 1/3 of the world economy to be in a recession, Kristalina Georgieva, managing director of the International Monetary Fund, said on CBS's Face the Nation Sunday. And yes, even countries that are not in recession, it would feel like a recession for hundreds of millions of people, she said. However, Georgieva stated that the U.S. economy is remarkably resilient and that policies like the Inflation Reduction Act and child tax credit measures are good for the U.S., good for the world. Wall Street is also anticipating corporate earnings reports, which are expected to begin arriving around mid-January. Companies have told investors that inflation will likely constrain their earnings and revenue in 2023, despite the fact that they have hiked prices on everything from food to clothing to offset inflation, which has helped to pad their profit margins. In quiet trading on Friday, U.S. markets reported further losses, capping out the worst year for the benchmark S&P 500 since 2008. The S&P 500 fell 0.3%. It lost 5.9% in December and will lose 19.4% in 2022, or 18.1% if dividends are included. This is only the S&P 500's third annual fall since the 2008 financial crisis, when it fell 38.49%, and a severe reversal for investors after the S&P 500 gained nearly 27% in 2021. According to S&P Dow Jones Indices, the index lost $8.2 trillion in value overall. The Dow fell 0.2% on Friday, while the Nasdaq fell 0.1%. The Russell 2000 index fell 0.3%. Stocks struggled throughout the year as the pandemic stimulus was phased out. Inflation put increasing pressure on consumers, and central banks boosted interest rates to combat rising prices. The Fed's key lending rate began 2022 at a range of 0% to 0.25% and ended the year at a range of 4.25% to 4.5% after 7 raises. The Federal Reserve of the United States anticipates a rate range of 5% to 5.25% by late 2023, with no rate cuts before 2024. Russia's invasion of Ukraine earlier this year exacerbated inflationary pressures by making oil, gas, and food commodity prices even more volatile in the face of existing supply chain concerns. Oil closed Friday about $80 per barrel, or $5 higher than where it began the year. However, oil rose above $120 in the meantime, assisting energy stocks in achieving the only gain of the S&P 500's 11 sectors, up 59%. Following positive U.S. job figures, Asian stock markets followed Wall Street higher on Friday, but were still on track for a double-digit loss for the year. Shanghai, Tokyo, Hong Kong, and Sydney all gained ground. Oil prices rose slightly. The S&P index gained ground on Thursday after the number of people seeking unemployment benefits grew only marginally last week, despite repeated interest rate hikes aimed at lowering inflation by dampening economic growth. Considering the market news was sparse, the shift higher has the hallmarks of a dead cat bounce, said Stephen Inns of SPI Asset Management in a report. The Shanghai Composite Index rose 0.4% to 3085.96 points. The Nikkei 225 in Tokyo rose 0.3% to 26,168.45. It is headed for an annual loss of almost 10%. Hong Kong's Hang Seng Index rose 0.4% to 19,803.77. This year it has dropped by more than 14%. The S&P ASX 200 in Sydney was 0.5% higher at 7057.40. Southeast Asian markets climbed as New Zealand fell. Markets in South Korea were closed for the holiday. The country's benchmark Kospi index is on track to lose more than 25% this year. In December, every major U.S. index fell. The S&P 500 recorded record earnings in 2022, but the index will conclude the year down around 20%, the benchmark's largest yearly fall since 2008. Investors are concerned about a series of interest rate hikes by the Federal Reserve and central banks in Europe and Asia to combat multi-decade high inflation. They are concerned that central banks are willing to instigate a recession if necessary. After 7 rises this year, the Fed's main lending rate now ranges from 4.25% to 4.5%. The Federal Reserve of the United States predicts that it will be in the 5% to 5.25% range by the end of 2023. Its prediction does not anticipate a rate drop before 2024. On the New York Mercantile Exchange, benchmark U.S. crude increased 19 cents to $78.59 per barrel in electronic trade. On Thursday, the contract slipped 56 cents to 78.40. Brent crude, the benchmark for international oil trading, rose 10 cents to 83.56 per barrel in London. It dropped $1 in the previous session to 82.26 per barrel. Meanwhile, the dollar nudged higher on Monday, regaining ground on recent 6-month lows against a basket of key currencies. The U.S. dollar has fallen as investors believe the Federal Reserve's tightening cycle is coming to an end. Sentiment remained weak, and the first trading day of the year was quiet, with several countries, including major trading hubs such as the United Kingdom and Japan, closed for the holiday. The dollar index, which measures the value of U.S. currency against a basket of major currencies, increased 0.14% to 103.63, up from approximately 103.38 last week. The euro fell about 0.33% to 1.0683 per dollar, but it was still close to its best level since June. The pound was down 0.35% at 1.2051 per dollar. The dollar sank 0.25% against the yen to 130.76, having hit its lowest level since August last month. There is an attempt by the dollar index to pull higher today, but we do see that it is losing a good part of the strength it gained last year, Ulrich Lutschmann, head of Forex research at Commerzbank, said. After the last Fed meeting, the market was not convinced that the Fed won't cut rates later in 2023. It's going to be an interesting year. After raising rates by a total of 425 basis points since March to combat rising inflation, the Fed has begun to moderate the pace of increases. The Fed's tightening aided the dollar's index 8% increase last year, its largest annual gain since 2015. Markets are still focused on central banks and inflation, as well as indicators of how long and severe a recession may last. Kristalina Georgieva, managing director of the International Monetary Fund, stated on Sunday that 2023 would be a difficult year for the global economy. Meanwhile, the factory activity in China fell for the third consecutive month in December, at the fastest rate in nearly 3 years. However, a jump in Eurozone manufacturing production has likely peaked as supply chains recover and inflationary pressures lessen, according to a poll released on Monday. S&P's Global Final Manufacturing Purchasing Managers Index rose to 47.8 in December from 47.1 in November, matching a preliminary estimate but remaining below the 50-point threshold that separates growth from contraction. While the Eurozone economy is in recession, concerns regarding gas supplies throughout the winter have subsided, suggesting that the slump may not be as severe as previously predicted. According to ECB chief Christine Lagarde, wages in the Eurozone are expanding faster than expected, and the European Central Bank, or ECB, must prevent this from adding to already high inflation. The recent euro strength is driven by a mix of things, including both the hawkish ECB commentary and hopes of a peak in U.S. rates, said Danske Bank chief analyst Piet Haynes Christiansen. It is also supported by hopes that the energy supply in natural gas is not as bad a situation as feared.